Well, all eyes are on the Fed and the Bank of Canada this week. Let's get more on what to expect from Kevin Headland, co-chief investment strategist at Manulife Investments. Kevin, thanks as always for joining us.
Thanks for having me.
What's it looking right now? I think the general consensus seems to be we're going to see at least a cut from the Fed, but and no movement from the Bank of Canada.
That's correct. Right now, I think the markets are fully pricing in a 125 basis point rate cut by the Federal Reserve. The key, I think, will be more so about the guidance and the minutes and the press conference that Chair Powell will be talking about. Markets are really whipsawing depending on this year what the expectation were Fed cuts. And in the next year, the markets are fully pricing in 2 additional cuts. And it'll be wait to see what the data says due to the government shutdown. Of course, we haven't had much data on the job front as well as inflation data. But going to next year, looks like still more cuts on the horizon. But markets, of course, want more cuts than perhaps the market is already pricing in. That'll be interesting to see. Bank of Canada definitely looking to be on pause right now. Although inflation is a little bit stickier, jobs data came in pretty solid last week. There's no reason right now, I don't think, for the Bank of Canada to look at either cutting rates or even think about tightening rates anytime soon. Again, they'll be data dependent, but I think the Bank of Canada will be on pause for quite some time, even into late next year.
And what are some of, are they doing this without the data down south of the border? I know that's been an issue. What are some of the numbers that they do have, and what are they looking at from them that may have an impact on the decisions?
Well, the jobs front, there are other pieces of data come through, ADP reports, Challenger job cuts, JOLT survey comes out tomorrow. So there's still some indication of the overall economic landscape in the U.S. There is consumer sentiment as well that seems still very resilient. Again, inflation, again, stickier, not really a big major issue. And the jobs data seems there is a weakness in the jobs data, but also not much hiring. So we're kind of seeing this no hiring, no firing type of environment in the U.S., which although it seems like it's benign, there's no reason to not cut rates right now. And I think this idea is getting rates down to a lower level from restrictive territory, which will just help alleviate some of the pressure perhaps down the road from where we have been at elevated levels for quite some time.
Now, it almost feels like there's no real one aha thing that could trigger anything here. It just seems like everything's just kind of going along like this, but nothing's saying yes or no, or where do we go?
There will be also some risks of having some dissent amongst the Federal Reserve members in terms of the announcement this week. There are some that perhaps don't want any cuts, some that want more cuts. So you're getting dissent on both sides of the ledger here because of perhaps the lack of information. It is, some would say, a Goldilocks environment. I wouldn't say it's hot, no, not too hot, not too cold. I think it's where it's a little bit cool, shall we say, but there's no reason why we should be worried too much about the over economic landscape or a reason to cut rates faster than they are, but definitely no reason to keep them, as I said, as elevated as they were over the past couple of years.
And how much dissent will be acceptable to the markets?
I think it's really interesting if we average out to the middle. If you have 1 or 2 dissents on the other side, you kind of average right in the middle. The key is the markets want lower rates. That tends to be the fuel for the fire. It has been in the last couple of months when you have had this whipsaw of market expectations for Federal Reserve cuts. When there's more cuts priced in, the market seems to be enjoying that. When there's less, the market seems to not enjoy that as much. And this is where it'll be key, where Jerome Powell, I think, in the press conference, will talk about the need to reduce rates, but also to pay attention to the overall inflationary market going down the road next year, the resilient economy, no reason to cut rates too quickly. And the market may not be too excited about that, but I don't think they'll be too upset about it either.
And we're looking at a new head of the Fed. What kind of an impact will that have?
That'll be quite interesting to see who's going to be the lead of the Federal Reserve next year, as Jerome Powell is no longer chair after May. Of course, we talk about politicizing of the Federal Reserve and the pressure from the Trump administration, but we have to remember that the Federal Reserve decisions are made by committee. It's not one member. So that'll be also something to temper expectations. But as we get closer to that date, there will be more uncertainty, and I think the market will react to that uncertainty as well. So I would expect next year to see some choppiness in the early part of the new year for the U.S. equity markets. Not necessarily elevated volatility, but choppiness. This is one where we're looking at the markets with elevated valuation, some decent earnings growth next year. I think this is one where you want to be looking at quality companies, not trying to win every race to steal a Formula One reference from the race yesterday. But this is one where you don't have to win every race to win the championship, and that's key, I think, right now for equity markets and for investors.
All right, just one last question before we go. Talking about global PMIs, the global composite PMI you noted went from 53 to 52.7, kind of again floating along. Any concerns or headwinds that you're seeing with that?
Well, I think when you look at Manufacturing Purchasing Managers Index, this is a key where it's a survey of manufacturers around the world. 50 is your expansionary level, so anything above 50 is expansionary, below 50 contractionary. So at 52.5, 53, again, it's not too hot. It seems like it's pretty strong. When we look at this manufacturing data, it's a great sign to look at the trend of the overall economic landscape. The big issue we're looking for, and what many investors around the world are looking for, is the risk of recession. And given the manufacturing data, the support that governments are doing from a fiscal spending perspective, and what central banks have done from a monetary policy perspective, there's little indication that we are in a recessionary camp. I think we're going to get below trend economic growth around the world in most spots, lumpy data depending on the country. But overall, no fear of recession right now. I think that is also positive for equity markets over the next year.
All right, we'll have to leave it there, Kevin. Thanks as always for joining us. Kevin Headland is co-chief investment strategist at Manulife Investments.